BRRRR, is that even a strategy? What is it? How does it work? Well, it is a strategy. It's BRRRR, and it's an interesting strategy. It has many other names as well. And in this video, I want to explain to you not only what it is, how it works, and why you might want to use it. If you're watching my content for the first time, my name is Hussain, and on this channel I have 3 videos a week to ultimately help you get further, faster in your property investing journey. So BRRRR, what is it? Well, it stands for buy, refurbish, rent out, refinance, and repeat. Now there's many different names given to this strategy, and sometimes in a different order as well, and different acronyms that are used. And ultimately it's about acquiring property, building property portfolio over time. This is why people want to use it, and it's about extracting as much cash out of it as you can so that you grow a portfolio using very little or a minimum amount of your money left in the deal. Sometimes people think this is a strategy that's become more popular more recently. However, it's actually a very old strategy that's evolved over time. So if we look back, say 2008, pre-2008, before the market crashed, many people were buying property. Some of it was off plan, some of it were buying regular buy to let, high loan to value mortgages. And what they were doing, they were buying those properties either no money down or a little amount of their money in, with a view of waiting to either refinance them over time or for their value to increase over time. Now, the market completely changed, mortgages changed in 2008 when the market crashed out, and the strategy has changed and evolved as well. So now in its current format, the way it's being used, let's break it down into exactly what the steps are. The first part of this strategy is to buy the asset in the right location. Now, the location is important because this strategy is primarily determined on what's the end value we're going to be able to achieve for that particular property. And when we do the purchase, there's many different ways that can be done. It might be a cash purchase if you're fortunate enough to have the cash, or it might be using other people's money, other property investors' money, which is essentially how I built my business. You've got somebody else's money that's coming into the deal to help you, whether they're lending you the money or whether they're partnering with you on the deal. And the most common method people tend to use is bridging finance to acquire the property as well in that way. And there's other strategies people can use, such as more creative ones, vendor finance, delayed completion. There's some fairly creative methods as well that can be used to acquire the property in the first place. But as I said, the key factor is what's the end value of that property going to be. Now, when we talk about value, there's a couple of things that we need to consider. For example, if a property is worth £100,000 and we manage to acquire it, say for £90,000, below market value as we refer to, then that's £10,000 essentially you've locked in right from day one. So you've got £10,000 of equity built in there. The other way that you can add value is by improving the property, by refurbishing it, etc., etc. So you're making the value something that you create that doesn't exist, or alternatively, you're buying at day one below market value. So they're the 2 key ways to lock the value in to the property right from the beginning. Make sure you watch all the way to the end, because I'm going to share with you the 5 biggest mistakes that I see people making when they try to implement this particular strategy. So the next thing we need to do after the purchase bit has happened is look at the refurbishment, which is how we can add value to the property. And there's 3 ways that we can do that. The first way is to reconfigure the space that's in the house that's already there. And for instance, we might take a 2-bedroom house and turn it into a 3-bedroom property just by changing maybe some of the partitioning around. Then the second way we can do that is maybe by extension. So for example, you might have a loft conversion, which has got a dormer extension on it, or it may be an extension on the first floor, on the kitchen extension. These are ways of increasing the volume of the property. The third way we can add value to the property is by modernizing and improving it so it's more desirable. For instance, new kitchens and new bathrooms tend to be the most common way people tend to do that. Once the refurbishment is completed and the property looks stunning, you've added the value, the next step is to rent that particular property out. Now, I often see people making a mistake in the order of this, and they think they need to refinance next. But ultimately, you need to have the property up and running, generating an income first before we move to the refinance stage. So here, when we come to rent the property out, the key thing is we're looking to do is achieve the maximum rent that we possibly can, because that's going to help and support the value of the property. Because the more rentable it is, the higher the rent value is, the more it will go towards supporting what the value of that property is also. Then of course, we need to ensure that we document and evidence who's living in the property, how much are they paying, some bank statements showing that rent coming in, before we move on to the next stage, which is the refinancing. And this is where the magic happens. Here at the refinance stage, ultimately what we're looking to see happen is for a bank, a lender, to lend 75% of what we believe the new value of that property is. Now, before that can happen, they will send out a surveyor, and you'll have to pay for this privilege, for them to go and look at the property, assess it, and determine what they think the value is. This is why if it's already rented, it's generating income, that helps. And this is where your documentation will also help in terms of what you've done to the property. So for instance, you rewired it, fitted new central heating, there's new double glazed windows, etc, etc, etc. Now, if you can provide a schedule like that, all that will help in supporting the end value. Now, of course, the key thing here is when we're doing valuations with the surveyor is what we call the comps, or the comparables. These comparables are what other properties similar to this have already sold in the marketplace, or had a recent valuation carried out on them by another RIC surveyor, so that it gives confidence into terms of what that figure is. Now, on a rare occasion, you'll have a property that doesn't really have very much in the way of comparables, and that can be a little bit difficult. And this is something you need to bear in mind before you purchase the property. But generally speaking, you want to be doing this in areas where the market's quite active, there's lots of comparables. That will give you the confidence that you can achieve the figure that you need to in terms of that particular valuation. Let's put some numbers on this just so we can get some context around how this works. Let's assume the property is worth £100,000 and you're purchasing it for £100,000. Let's say it's a cash purchase, just to keep things nice and simple. Now, you spend, let's say, £20,000 improving its value, making it much nicer, new kitchen, bathrooms, a light refurbishment, whatever it might be. And let's say, for the purpose of this example, it's now worth £150,000. So you have a £30,000 increase in value. Now, the property value is £150,000. A surveyor comes out, carries out their valuation. Let's say they're happy with your house and say, yes, they agree it's worth £150,000. So the bank will now lend you 75% of that, which is about £112,500 if my maths is right. And that means you've now got £112,000 back from the bank. So what you've still got left in the deal is £7,500 of your cash. That's still stuck in the transaction. Now, when you borrowed the £112,500 from the bank, let's say you have an interest rate of 4%, that means you're paying around £375 a month. And again, let's keep the number simple. Let's say you're renting the property out for £600. That means you would have an annual profit of £2,700 a year. That's before maintenance, management and voids, just keeping it simple right now. But you've got £7,500 of your money still stuck in the deal. Now, if you do what's called a return on capital employed, or a cash on cash return on investment, what that means is you're generating over 30% a year return on that £7,500 you've got stuck in that property. Now, when you compare that with alternative investments, like the bank tends to be the most common one people look at, which is what, 0.01% or something crazy like that, virtually zero is what you're earning. So that's a phenomenal return. And this is another reason why the strategy works really well. So in the example I've just given, what we did, we added value to that particular property. But earlier on, I spoke about a second way to be able to lock in that value, and that's buy the property below market value from the beginning. So let's go back to that example. Let's look at the numbers in a slightly different way. Let's say the property is worth £100,000 as it was earlier, but now you're purchasing it for £90,000 as opposed to £100,000. So you've locked in £10,000 discount or equity from day one. The renovation is still the same at £20,000. The end value is still the same at £150,000. And now when you remortgage at 75%, again, the numbers are the same. You've got a mortgage of £112,500 and £37,500 of equity locked in the deal. But now you've got £112,500 back, but your spend was £90,000 on the purchase, £20,000 on the renovation. So in fact, you've got all your money back, the £110,000 plus some, in this case £2,500. Now here's the thing that's really important. This is debt we were talking about. So when we talk about getting cash out of the deal in this way, what you've done, you've increased the debt that you have on the property, but ultimately all your initial investment has come out and you still own a house for free. Now when you get your head around this is crazy. So it means you are able to extract all the cash out of the property, still get that rental profit each year that we talked about earlier on, which is £2,700 a year. Now, when you tie this in with the bigger picture of what happens to property over the long term, now generally most people invest in property understand that the values will increase over time. There's no guarantee here, but if we look at past history, what's happened in this country, the values rise over time. Let's say whether it's 10 years, 15 years, 20 years, it doubles in value. I'm sure you'll know of times where property values have doubled previously. I can think of several times where it's happened over previous years, but let's say it happens at some point in the future. Now your £100,000 property, which you purchased for £90,000, that was worth £150,000, let's say it doubles and it's now worth £300,000. At this point, your equity in that property is now, if I haven't got this mistaken, about £187,000. That means you've made a significant profit based on what you did several years ago as a purchase at that point. Now let's say you do a handful of these, let's say you did 5 of these, what would that be worth? That's £1 million of equity you've created by property that you've purchased, extracted your money out of, you own without any of your money tied up in, and £1 million of equity in there. This is the magic of using this particular strategy. Ultimately, what that means is your return on capital now is infinite. It's infinite because you've got none of your money left in it. It means you've had your money back out, which then leads us nicely onto the 5th and final step when it comes to this strategy, and that's simply repeat. So what that means, you go again, you buy another property, you go through the same process again, and you could do this with 1 pot of cash. But just imagine you had 2 or 3 pots of cash, what you're able to do. And this is why this is such an amazing strategy if it's done right. Before we go into the 5 biggest mistakes that I see people making, if you're enjoying this content, then make sure you smash that like button, subscribe to the channel, and enable the notification bell. And this way you'll ensure that you don't miss out on the content as and when it's released. And also it helps us get the content out to more people just like you. So what are the 5 biggest mistakes we see people making? You might be thinking right now, Saj, if this is such an amazing strategy, then why do so many people speak so badly of it? And the reason they speak badly of it is because they get it completely wrong. They make so many mistakes when they're doing the strategy. They understand the high level theory, but they get all the details wrong. So let's go through those 5 steps. The first one is they buy in the wrong location. They buy in low value areas where they come to refurbish the property, they struggle to increase its value. So they buy a property that's cheap, but the reason it's cheap, it's in a cheap area and you're limited in terms of what you can do with an increase of that value. So you're not able to refinance it at the right figure. It means you've got an enormous amount of money stuck in the deal and it doesn't work. The second mistake people make is they underestimate how much a refurbishment will cost. So you might do a light refurbishment, that might be just carpets, painting, etc. You might do a medium refurbishment when it means changing the kitchens and bathrooms as well. Or it might be what we call a heavy refurbishment, where you really strip the property down and gut it right down and pretty much everything is brand new, which is my preference in terms of how we do that. But the costs increase massively at each stage, and of course the quality of the finish makes a difference as well in terms of the work you're doing. So people underestimate how much it actually costs to do the work. So by the time they've finished the refurbishment, they've eaten into all their profit. There's very little actually left. The next mistake people make is the time that it takes is also underestimated, and they think how quickly they can get this done and turn it around. So one of the challenges around the refinance is most lenders want you to have owned the property for at least 6 months. So that means when you apply for a remortgage, you'll have already owned it for 6 months. That means you have much more products available to you to choose from, and a good mortgage broker will be able to help you with those. But if you think you're going to refurbish the property in 4 weeks and you're going to remortgage it in month 2, well, then I'm sorry to disappoint you. You're probably going to struggle. There's very few lenders in the marketplace that will offer you products, and generally they're not going to be at the best rates. The next mistake that I see people making in this strategy is that they lack the experience. So that's not the experience in terms of doing this, but they're, from a lender's point of view, they're seen as inexperienced. So what that means is they might not own their own home. They go off and purchase a property to be able to buy and refurbish in this way, to be able to use it on this particular strategy. And when they come to remortgage, again, they're limited in terms of the products and which lenders would even entertain a mortgage application from them, because they don't even own their own home and they lack the experience. The fifth and final mistake I see people making with this strategy is that they get the rental numbers wrong when it comes to the mortgage, i.e. the deal doesn't stack. Because when you're applying for a mortgage, you need to have a certain amount of excess rent over the mortgage payment you're going to be making each month. And if you want to know more about that, then make sure you watch the video. We'll put a link in the description below. I've got on buy-to-let mortgages where we talk about it in a lot more detail. But making a mistake here means you will not be able to exit out of the deal in the way that you want to. So a lot of these mistakes are really around the exit of the refinance and not really knowing enough about that. This is why it's absolutely key that you get these things right in order to succeed, because when you do get this strategy right, the rewards are absolutely phenomenal. Hey, look, I hope you've enjoyed watching this video. I just want to say thank you so much, and I look forward to seeing you again on the next video.